Hi there, I'm Shraddha Yadav, and today we're gonna have a quick introduction to currency markets and exchange rates. So, what is a currency market? Firstly, if you hear foreign exchange market or a forex market, it also means the same as currency market. It is an over the trade counter trade market, unlike the exchange trade, like a stock market. And what basically it is, like in the stock markets, we buy and sell stocks and shares. Here, we basically buy and sell currencies. So whenever you are exchanging a dollar for a rupee or a yen for a rupee, you are basically buying one currency with the other. Why is it important? Because let's just take example of imports or exports. Whenever you are doing a transaction with another country somewhere for any purpose, you're essentially buying the goods or selling the goods to them in the currency they want. For example, if you're importing something from United States, what you're doing is you are buying the good and paying them in United States dollar. So, because you are in India, you do not have the United States dollar with you. What you would be doing, you would be exchanging your INR with USD and then making the payment in USD. So for that purposes, having a currency market becomes very important. And it is just not limited to imports and exports. It also um, it is also uh, very important for acquisitions of corporate, like a company situated in UK wants to acquire a smaller company or a startup from India or Switzerland. They would need those countries' currencies to make the transaction, and then there are international loans given. We have masala bonds and all. For all this, we need different currencies to be converted from one currency to the other. And who are the main players in this market? It is mostly central banks. They do it typically to control inflation, and of course, there are other reasons as well. Then we have retail forex brokers, hedge funds, and so on. Moving on, every currency is denoted by a code that you have noticed, like US dollars is denoted by USD, Indian rupees denoted by INR. Then we have pound sterling denoted by GBP, Japanese yen by JPY. So what are these things, these codes that we represent them with? They are designated by ISO. Here it is a three-letter code in which the first two letters represent the country name and the third letter represent the currency name. So in INR, IN denotes the India country name and R denotes the currency name rupee. Similarly, in CHF, CH denotes the country name for Switzerland and F stands for France. That is the currency name. Here, something important to note is wherever possible, because there are many currencies where this particular code is not possible to apply, and hence it is not applied there. Then, why do we need this course? It is basically to have more clarity and avoid errors. Moving on, let's take a few examples, numericals, and try to understand the calculations of this. Alright, so here let us assume that the GBP INR rate is 97.08. Okay, firstly, what does GBP INR written like this mean? Here it is a universal way of writing it. Here GBP becomes the base currency and INR becomes the core currency. So anything before the slash is the base currency and anything after the slash is the quote currency, and base currency is always taken as 1. So here what we mean is, for every £1 sterling, for every £1 sterling that you want to buy, you will have to pay 97.08 INR. Okay. So here let us try to find out what the exchange rate for GBP INR would be after 1 year. So what we are essentially doing here is taking the current rate and multiplying it with the inflation that each country would have, and we're getting the answer. So after 1 year from this point of time, in the future, we would have the GBP INR rate as 102.07, meaning for every £1 sterling that we buy, we have to pay 102.078 Indian rupees. Let us try to calculate another one for 2 years. So it would be the current exchange rate of USD INR multiplied by the inflation rate of both the currencies. But is this the correct answer? No, right? Why? Because we did not consider one factor. We have calculated for 1 year. Since it is 2 year, we will need to raise it to the power of 2. Why? Because it would get compounded over 2 years. So the exchange rate would become 71.0791. Alright, here I took two examples to basically explain that when your inflation rate is less than that of the other country which you are comparing your currency with, your currency is basically appreciating. And if it is vice versa, then your currency is depreciating. Moving on to the next question. Here, what happens is sometimes some currencies cannot be directly converted into the other. For example, pound sterling, if we are to convert into INR, we would not get a direct quote from banks for this. What we will need to do is first convert it into US dollars, and then we will have to convert US dollars into INR. So what do we usually do is we take the exchange rate of these two pairs, GBP USD and USD INR, and then like we used to do in our schools, just multiply them and get the answer. And again, the same thing here as well. And now coming to a question, is this really the right rate at which we would be um, getting the currency exchange if we went to a bank? Well, not necessarily. Why? Because there is a spread over all the currencies, and the bank will charge you the rate according to that. So let us get back and try, and I'll try to explain some terms to you before we move on to the next question. Here, what is the spot price? It is the price at which the exchange rate at which the currency is currently trading. For example, if we say the current exchange rate is for USD INR is 73, then it means for every $1 to buy every $1, someone is paying 73. Now, what is the bid price, ask price, and the spread? Bid price is basically the maximum price that a buyer is willing to pay for the currency. So, for example, you have $1 and you go to the bank and say, I want to get INR in exchange of this US dollar. What does the bank say? All right, the current spot price is going 73. I'm willing to pay you maximum 72.5 for it. So since the bank is willing to pay you maximum 72.5, that becomes the bid price. Then the ask price is exactly opposite of that. So you go to the bank and say, "Hi bank, I want to buy dollars from you. I will give you INR, you give me dollars." What would the bank do? Since the current spot price or the current exchange rate is 73, the bank would say, "All right, you can. I will give you $1 for every 73.5 INR that you give me." So what the bank is essentially doing in both these cases, it is making 50 paisa at every exchange, right? And the difference between these two, that is 72.5 and 73.5, the difference between the bid price and the ask price becomes your spread. That is how much they can spread across. And the spread is also known as buy sell spread or bid ask spread, which really isn't very important because whenever there is a word spread, all you need to understand is the difference between the two. Moving on to another question. Moving on to another question. Here we have the spot price, bid price, and the ask price. Like I said, GBP to INR conversion is directly not possible. So we will be first converting GBP to USD and then USD to INR. Here we have the spot price for both exchanges. We have the bid price for both exchanges and we have the ask price for both exchanges. Let us try to understand this first. So currently, for buying every £1 sterling, you have to pay 1.28 USD. These are not current values. I have just taken them randomly to explain this question. Alright. So, what do you understand by this spot prices? To buy every £1 sterling, you will have to pay 1.28 US dollars for it. But now, what you do is you go to the bank and say, "All right, bank, I have some pound sterlings, but I need US dollars in exchange for it." So what does the bank say? "All right, since you're giving me US dollars and it calculates a spread across the spot price, it says, okay, I'm willing to pay you maximum of 0.98 US dollars for every pound sterling you give me." And you're like, okay, because you really don't have an option. There is different bid and ask price for every bank, and let's assume this is the best bid and ask price you could get. So you really don't have an option but to exercise here, right? Then what you do is, now that you have US dollars, let's just assume that now you want them converted again in euros, sorry, in pound sterling. So what do is you go back to the bank and say, "Hi bank, I have some US dollars. I will give them to you and you pay me pound sterling." What does it say? It says, okay, I will give you pound sterlings, but you will have to pay me 1.58 US dollar for every pound sterling I pay. So what essentially happening here, the bid and ask price, we are looking from the perspective of the bank and not our perspective. So whenever a bank is buying the currency from you, it is quoting a lower price than the exchange rate at current exchange rate or the spot price. And whenever it is selling to you the same currency, what it is doing, it is quoting a higher price just because to make some profit out of it. All right. Here we just took example of one bank where the bid and ask price is this. Let's assume for another bank it could be something like 1.38, let's say. For some other bank it could be something different, and for some other bank it could be something different. So every bank has their own bid and ask price, but the spot price remains the same. All right. Same thing goes for USD INR. Whenever you're going to the bank, you will this is the current spot price, this is how much the bank would quote to buy the US dollars from you. It would say, for every one US dollar that you're giving me, I'm only willing to pay you 72 INR. And for every $1 you want from me, I will you will need to pay me 74 INR. Alright. Now coming to the spot price and understanding how it is different from our question above. Right? So what happens here is, what will you do first do? You will take your pound sterling to the bank and say, okay, I'm giving you pound sterling and you need to give me US dollars. What would the bank do? Bank would take it from you and exchange at the bid price, right? Then you take the US dollars and go to the bank again and say, I want it in INR. What would the bank do? It would convert it into the ask price, and that is how you get the spot price for the cross currency pair. All right. Now coming to bid and ask price. How do we calculate that? We got the spot price, but to calculate the bid and ask price, we need something that we do not have here in this question, right? That is the, yes, you're right, that is the spread. What, what we usually do here is we assume what the spread is. Let us say the cap on the spread for now is 2 INR, so that is the maximum bank could deviate from the spot price. So what would be the bid price it asks? It says for every £1 sterling you will have to pay the spot price. I will pay you the spot price minus 2 INR. And for the ask price, it says for every pound sterling that you want from me, you will have to pay me the spot price plus 2 INR. Alright? It is 2 INR on both sides. The spread is 2 INR on both sides of the spot price. I hope everything was clear to you. And next video, I'll be discussing about the introduction to options contract. It will be a quick theoretical video, so stay tuned in for that.